Well, the About That Wallet podcast, where we help the sandwich generation build strong financial habits so that they can talk about money, spend money, and enjoy their money with confidence. I have somebody who has been doing this for well over 30 years. Can you believe 3 decades worth of content? And not just content, but really living this stuff, like going through school, going to college, and really wanted to help everybody else. And it kind of shows in this character. So welcome to the show, Chad Taylor. How you doing today?
Thank you, Anthony. I appreciate it. I'm glad to be on the show. And just one clarification, not well over 30 years, almost 30 years.
Almost it.
Yeah, I don't
I
want
mean,
to be that, age that much. So
okay. Cause I was like, you look pretty good doing 30 years out there. So, you've been talking about like legacy building for such a long time. And my audience is the sandwich generation. And that's one of the things that we try to do. Can you kind of dive into one of those money myths that you had to debunk while you're going through your journey that kind of helped you define who you are today?
yeah, if I was to debunk anything, I think a lot of it is it's the fast money concept, right? Like we want it all today. And so as we're building our wealth or building our 401k or whatever it is that you're trying to accumulate, and you're starting out, you're adding the, 1,000 or 2,000, whatever it is per month to the portfolio, and you're looking at it, it's like, man, I'm not getting anywhere. It's like I'm trying to accumulate to this X amount of dollars in the future, and I've got $20,000 in the account, right?
Yeah.
And we get frustrated, we get discouraged by that, seeing that amount. But eh, once you start doing it and start adding to it, you really start to see that thing build up over time, and it's the compounding effect of the continuously adding to the account and letting the account do what it's supposed to do, and not try to get caught up in the fast money that's out there, right? You look at these stocks that have just shot up here recently, and it's like, oh, I got to own Micron or Marvell or SanDisk, and so you start jumping on these quick stocks to try to multiply that asset you're trying to grow faster than it's growing currently. And then you start thinking you're trading these stocks, and then all of a sudden the stock drops 20% on Friday when the numbers aren't as good, right? And so it's not taking the time to let the portfolio grow for you, and jumping on the quick and hot trends that you see on TikTok or YouTube, and staying disciplined to your approach.
Yeah. And that's one of the things that everybody want to get rich quick. And this is a slow and steady process. So how do you get out of that mindset that you have to do it now?
It's hard. I had a meeting with a client about 2 weeks ago, and they're like, "Man, we're not on track for our retirement. We got to do this, and this to get there." And I was like, "Wait a second. Let's hold up for a second. You're not as far off as you think you are. You've got this client was 20 years from retiring,
Oh,
and
20 years. Right.
yeah, right. But they're looking at what their goal was
Mhm.
and they're looking at their current account. And I was like, let's do this in the financial plan, and let's say, this is what you're currently at asset wise. This is what you're saving. This is what our goal number is, and watch what happens when you do the compounding effect. And we put it in the financial plan, and doing what they're currently doing without changing anything, even though it seemed like a huge number to get to, they were past that number. And
Mhm.
so it's really, I think, to see it in a plan, in a number where it's forecasting out for you from what you're currently doing, what you're saving. I think that helps people stay on track, because this client went from being super nervous about where they were and having to save so much more and not being able to afford the house they wanted because they weren't saving enough. Like, oh my gosh, I can actually probably get a little bit more house than I wanted to, because I'm on track with what I'm currently doing, even though it seems I'm 5x, 6x off from my goal.
Yeah. Well, I mean, because even being 5x off, I mean, they always make like the numbers are so higher than what they really are.
Yeah.
Everybody talk about 10x this and 10x that, but just to be 5x off, it's not that bad in a sense.
Yeah, and I mean, I'm gonna, talk numbers for this client, but they're sitting there and they're, 40 years old. They had
Mhm.
about $700,000 in the account, and their goal number was over $7 million. So,
Wow.
um, so when you're looking at that, you're just like, man, that's a big number to get to in 20 years. But on average, without doing anything, your account should double, every 7 years, right? So
Mhm.
600 to 1.2, 1.2 to 2.4, and probably a third double for them. They're at 4.8, plus they're saving. So see, like even when I said 600,000 to 7 million, you kind of like, oh, but just by showing you that, plus they're adding to it, they're over $7 million in 20 years. You
And
know,
that's without doing anything additional.
right? Not even, I mean, just staying with their current savings goals and actually even probably even add a little more expense because they're going to get a little bit bigger house than they were anticipating. But yeah, it's just sticking with their plan and their disciplined savings.
Okay, so that gets you to think of like being that leadership role and actually having that intent for your finances. But like, how does that like correlate to now start leaving that true legacy? To me, I think legacy when it comes to finances is about education, versus more so than the dollar amount. Because if you can educate somebody, that nobody can really take that away, but the finances that can always be taken and replenished. So I'm thinking of leadership in a sense like, hey, I laid the groundwork in the sense of, hey, this is the educational, these are the resources to kind of go forward. What are your thoughts on the legacy around between the education versus just a dollar?
Yeah, well, I think, it kind of comes to, I think you need a little bit of both, right? Because the dollar amount is what it comes down to,
Yeah, that's true.
right? But again, sometimes you can't control the dollar amount. Things come up, expenses come up, markets crash. And so I think having the understanding with the legacy and the education to understand basic financial planning, basic markets, how to react when the market's selling off. Do we sell everything or do we buy? I have clients, which not as much anymore, but every time the market moved 5%, they panic and say, "Do we need to start selling and go into cash?" And you'll never be successful that way. And so, through time and educating them on how the markets work and how time in the market and the markets recover, and sometimes showing them an example on a chart where we'd go back 15 years and say, look, we went, this is a financial crisis in 2008, 2009. You lost 60% of your money during the downturn, but going out 15 years later, it's gone from the low on the S&P was 667, I think, on the S&P,
Oh,
and
wow.
then today, it's at, what does it say, 7,300 on the S&P, 16 years later. And so educating them on the markets, bear markets, recessions, how you react during that time period, getting them to act on it's a different story, but educating them on how it works and having that knowledge of how to get through it and how to, manage your emotions during that time period is probably one of the best things you can do. It's not, you hear a little thing, it's the markets was managed by fear and greed, and it's really true.
Yeah. I mean, there's a lot of fear in the streets. I
Yeah,
mean, that's what get everybody going. Because a lot of people are looking to purchase now and or sell when they see it going down versus looking
right.
at it as a sale.
Yep.
And that's one of the things I'm constantly saying on this show. It's like just because the market's going down, it's like a red market or a red ticker on a shirt that you just purchased. If you purchased it at $20, now it's on a red sale, doorbuster sale price for $5, you can go back and get it again. I mean,
Right.
or not, just let it be there.
Yeah, and I think, that comes into with being, having a good allocation, right? Because
Mhm,
if sometimes, buying a stock that's on sale, that's a one individual stock risk, right? And so you can get burnt catching that falling knife, right? Because
mhm,
that stock went from 100 and went to 70, then went to 50, then went to 40. And then those are hard to make up. So you're buying it on sale and it keeps getting cheaper and cheaper and cheaper. Now you got to make up a big loss in there, right? But if you're looking at, dollar cost averaging into a diversified portfolio where you don't have that single stock risk,
yeah,
I mean, you buy stuff on sale, it's just, I mean, that's what you want, right? I mean, granted, we want the prices to go up and we want to have more down the road. But when the market's selling off and you're buying into good companies or diversified, I mean, that's the best thing you do for your finances. You're just, buying at cheaper levels.
yeah. I mean, you can't beat that though. I mean, that's what
Yeah,
we're here for, right?
right. Yeah, exactly.
Now, because hear about your family going forward. Has that been something that you guys talk about normally about finances or investing? Have you introduced that to your kids yet, or?
I have, so I've got 4 kids.
Mhm,
The 2 older ones is who we've talked to. The 2 younger ones are too young, so it's 18, 15, 10, and 7, right? So,
mhm.
the 18-year-old, it's a challenge, I hired her as an intern, and I've add money to her Roth IRA every month, and, I talked to her about investing, and she's also working outside of my company with another company, holding two jobs, and she's in that paycheck, and she sees that paycheck as spending money, right?
Of
And
course.
I'm trying to just like we talked about, educate her on the fact, hey, if you make this $1,000 this month, you know, you got to set aside for your taxes. I said, but I want 25%, $250
Mhm.
coming into your account here and start saving it. The rest of it you can spend. Have fun, go do what you want to do, but you need to get that mindset of paying yourself every month. Um, and it's like talking in one ear and going out the other, right? So and so I'm helping her with it. We're going through this, and I think this last paycheck is starting to come through a little bit. I think we're going to see some money come into her account. She'll start saving,
Okay.
but each kid's different, right? The 15-year-old, he gives me money all the time. He does little odd jobs around here for me. I put his money in a Roth IRA, and then he does some stuff. He helps out with a little neighborhood business here, and he'll come back and give me 500 bucks, 600 bucks every couple of weeks to put in his account and start saving, and he's built up a nice portfolio. And so he's 3 years younger and has probably two and a half times more than his sister does, right?
Mm.
And so talking about that, they can see the difference of putting this money aside. So but I think it's very important to talk to your kids about it, and try to educate them as much as you can, because this isn't taught in school.
Not at all. And because people want it to be taught in school, but I don't think they have, I'll say not the expertise, but more so I won't say the time because that's kind of their job if they're gonna
Right.
do it.
Yeah.
But I'm just thinking of like how can we teach the teachers on that, or like find something that's very elementary where they can just do a step by step by step to teach
Yeah.
them.
I think, if they just did a basic finance class, right?
Mm,
How to balance your checkbook, how to save, what's an IRA, what's a Roth IRA. If they just, I know we had to take economics in high school, and
yeah,
if
we
you could
did.
just even take a little bit of that out of that class and just teach basic finance in it, I think would go a long way.
Yeah, because I think we even taught trading when I was in economics class. The thing
Oh,
about it,
really?
we didn't have he didn't tell us what brokerage account to go into
Yep.
to start doing it. But obviously, we it's not as quick and accessible as it
Yeah.
is now. So
Yeah.
yeah,
Yeah, I know we had to pick some stocks in our class, and they tracked it throughout the year.
mhm.
I think that was in my finance or economics class. I do remember having that in high school as well.
Yeah, they gave us the paper money, and I think the people who won the most actually got like an A automatically. I was like,
Oh, really?
yeah,
That's not fair.
yeah, and like we all had to struggle and take extra courses, extra tests for that reason.
Yeah.
Um, but yeah, it was just fun times back then, man. I don't know. Maybe we should do that for adults. To just gonna give everybody like paper money again.
Yeah. I think a lot of people need it, that's for sure. Yeah.
Yeah. But then you're kicking yourself because like, well, I actually do got $1,000 I could have invested in it, and they,
Right.
yeah, yeah.
Yeah.
Um, yeah. So, because I guess you could say as we approaching throughout the rest of the year, I mean, we practically here at the middle part of the month, the year. Um, and we just want to make sure that we continuously go forward. So with your business, what do you see that would actually kind of help people today to kind of line them properly so they don't have to come see you immediately?
Yeah. Well, yeah, I think everybody's in different stages, right? So it's
Yeah.
kind of a tough question to answer, but if they're not starting, I mean, I think you've got, or they haven't done anything for themselves yet. I think you just got to set up that mindset to pay yourself first. It's start as an account, and it's a bill. Whether it's 200 bucks or 400 bucks a month. Just consider that a bill you have to pay, and just start that account, and then you start seeing it grow. Then it becomes addicting, right? Because it's like, oh my gosh, I built up this amount, and maybe I can do 500 bucks this month. And and I think it's like everything else. It's like just taking that first step and getting started with it. But I think you've got to find a way to start putting money aside on a monthly basis and make it automatic, so you don't even think about it. You know,
So,
like, I was just gonna say, going back to my
uh,
kids, what I
mm,
did, my parents and my wife's parents and aunts and uncles, I said, "If you're gonna spend 100 bucks on my kid for Christmas or birthday, spend 50 and give me 50 bucks to put in their account." And so I started putting money in there because the toys and stuff, they've been there for a couple months and they're in the closet, but they're not going to miss it, that $50. And so, I built up those accounts for my kids and to get them started on it.
Yeah, that yeah, because what you call this graduation season right now, and so no, you good. Life happens. Uh, Graduation is right now, and so
Yeah.
a lot of people are gearing up, and even Father's Day. So like some young fathers and so forth, and um, planning this out. Is there like something that you're looking forward to as Father's Day besides the tie?
Well, we actually we travel every year. It happens to be on Father's Day. My two middle kids are big soccer players, and so June is the month off for their tournaments, and
Mm,
so we'll be in Costa Rica for Father's Day.
nice.
Yeah,
See, you living a life. Okay,
yeah.
so all right. Because I want to make sure I be respectful of time. As far as going into the futures, that's where we want to go into in really aligning just your life in general. Considering going on lovely vacations in June, that's pretty cool. Is
Yeah.
it? Do you like save up throughout the year, or is it kind of like, hey, I'm gonna put $5 away on like a high yield savings account, or do you just cash out some shares?
You're talking about for vacations and
Yeah,
things like that?
yeah,
So I put money aside each month, and so what I do is every month I here we go, sorry.
it's okay.
Busy time of the day. But, so every month I put money aside into a savings account, which for me is in my brokerage portfolio, and I just buy California muni bonds, short-term
Mm,
California muni bonds. And so each month that goes in, and then I know in June we're gonna spend money on this vacation, and I just cash those out to pay for the vacation, and then I start saving up again, and each year, so I make little buckets. So
oh,
I got like a
cool.
vacation bucket, I got a property tax bucket, I got I pay my taxes quarterly because I'm a self-employed. So every quarter, I put money aside in a high yield money market for those taxes. And so again, kind of like paying yourself first. I know those expenses are coming up, so I just put money aside each month to make sure I have money set aside for those little projects that I have throughout the year. So I do it on a monthly basis.
Okay, so you mentioned something about the bonds. Like that's one thing I haven't invested in. So with your brokerage account, do you set? I mean, it's almost like you're using your brokerage account almost like your savings account. Like each, like, do you just do like a basic bond setup or like ATF? I mean, just
Yep.
I know we can't talk specifics, but at
Yeah.
least
Yeah. So what I do, I actually have a separate brokerage account that is just for these projects. So it's
oh,
not
cool.
part of my main one. So that way it's not commingled, and I don't see that money sitting there and saying, "Oh, I'm going to buy this stock when the market's down." I know it's set
Yeah.
aside. But you could actually do it inside the same brokerage account. I just like the clean delineation between the two. And so, yeah, what I do is I look in, obviously, because these aren't longer term needs or short term needs, so you can't take risk with them, right?
Mhm,
And so I buy an ultra short muni bond, which
mhm.
means you're not taking as much risk with the duration. That's going to get me, 270 to 3% federal and state tax free. So, equivalent to about 4% of yield. And looking at that, high yield money market is paying, 3%, 315
That's right. Yeah.
taxable. So, but it's safe. It's a lot safer than the muni bonds because muni bond, I shouldn't say a lot safer, but muni bonds can go up and down based on what's going on in the marketplace. Where the money market's going to stay, basically, you're going to get your yield. But yeah, and I just kind of earmark my assets to my time horizon. Short term need, I can't take risk with that money, so I got to be money market, ultra short bonds, things like that because I don't want market risk. Because last thing I want to do is put my property tax money aside in the stock market and have the stock market drop 20%. So it
Right.
stays in a short term conservative investment.
Mm. And so they always say, what is it? So do you leave it? I can say because I know it's short term. In short
Yeah.
term in your realm is what, like 6 months?
6 months is I consider ultra short.
Okay.
So, because that's money that, does not have time to recover even if rates moved up a little bit.
Mhm.
So that is like, cash, ultra short bonds, very, very conservative. But 1 to 3 years, you can go out to more of like a little bit longer term bond, like a short bond, not ultra short, short bond, because now you get a little more time for recovery, right?
Mhm.
So, I'd say less than 1 year, ultra short, 1 to 3 years short, 3 to 7 years intermediate, and then past 7 years is long term.
Okay. So if we go on our broker, because I use Schwab, and
Mhm.
so if I'm looking, for this particular bond? Because I never heard of these bonds before. So is it like a particular like? Do you have an example of one that at least we can kind of look into?
Yeah, so, this is be one for if you're in California, right? GCal, which is the Goldman Sachs California Muni Bond,
Okay.
and that's an ETF, low
Oh, cool.
cost to get into it. That's one that's California. National, there's one called Vanilla, VNLA, which is a Janus ultra short taxable bond fund. So there's a bunch of them that are out there. You just got to search and see what's available for you and what state you're in. And some people, if you're in a low tax bracket, you don't need a muni bond. You need a
Uh,
taxable bond or a money market because if your tax rate's 15%, the tax isn't that big a deal for your interest. You're better off paying tax on the interest you're receiving.
uh-huh. See, now you're going to the tax realm. I'm a little lost in that one. I mean, this is the reason why I do the show is to educate.
Yeah.
So when you talk about these, what would you be consider that bracket to kind of break over and say like, you know what, now it's I need to start looking into to
Yeah, probably
these.
28, 30% is when you look at muni bonds. It
Gotcha.
depends on what's going on in the market and what how how muni bonds are paying, what their current rate is versus that compared to a taxable bond. There's times when a muni bond will pay almost as much as the taxable bond, and
Oh wow.
even a lower tax bracket would be better off in munis. Right now, I'd say probably 28% bracket, you're and below, you're better off in a taxable bond, and over 28%, you're probably better off in a muni bond.
Okay, because I'm looking at like how much would that be considered? It's almost like I had to Google it. It's like so it looked like income over 201,000. That'll bring
Yeah.
you up to that 28 percentile.
Yeah, and that's it's a marginal bracket, right? Because it's progressive. So, might have to go, 300 and some thousand to get to the 20% marginal rate. Or if you're, single or married, it changes a little bit too.
Yeah. And this is great information because like, you know, in case people hit those certain numbers, and I just want to make sure like, hey, we all learn on the same page
Sure.
on because that's the reason why I like this show is that we can learn throughout our time here. And then you have it automatically set up to a percentage of based on your income. Now, because your income, because you're self-employed, it's fluctuates. So
Yeah.
do you do just percentage or do you just try to make sure like, hey, I'm gonna try to hit this minimal amount?
Yeah, I know every month, like I want to put aside a certain dollar amount for the vacation.
Mhm.
I know I'm going to put a certain dollar amount away for the property tax, and because I am self-employed, I got to pay those quarterlies. So I just basically take what I'm going to distribute each month for my income, and I take away about 35% for federal, and
Mhm.
another 10% for state that I put aside into a tax bucket for my quarterly tax bills. And my 35% you know, probably overkill, but there's other little taxes in there that I got to pay that are more than just my federal tax. So I account for those as well too. But yeah, I just, because I'm self-employed, um, I just know that if I distribute, $10,000 that month, I need 300 or 3,500 go for federal. I need 1,000 for state taxes. And then I got 65% to work with, vacation fund, X, and it just gets split out.
That is so cool. Yeah, man, that is awesome. Like I want to actually be able to have that opportunity to do that too. We'll get there one day. So is there anything you want to get into before we dive into the final four?
Um, no, I think we've been on a pretty good track. I think we're kind of digging into some taxes and a little more complicated things, and
Mhm.
but I think for the most part, it's high level without going into too much detail. So let's do the final four.
Alrighty. Cool. So question one. What does wealth mean to you?
Well, I think wealth is different for everybody, right? So, I've, I track wealth, and I track wealth for myself, my clients, and everybody's got a different version of what wealth is. I think for mine is that cash flow that takes care of all my expenses,
Mhm.
and then that gives me time to spend with my family and kids and be there for all their soccer games, the practice I need to go to, do the vacations and be present with them. That to me is probably is the biggest thing what wealth is.
Nice. Number two. What was your worst money mistake?
2007, 2008.
Oh,
So I think you probably weren't, yeah, you were around for that time period, but you
mm,
weren't doing this stuff and don't know how bad it was. But
no.
that was, hopefully, knock on wood, the worst financial crisis I'll ever go through, and hopefully for your audience, they'll never go through something like that. But 2007, 2008 was, yeah, it was horrible. And we made good decisions in that time period, but um, it was, you saw your assets and your business just get dragged down, and even if you're defensive, you lost money, and you lost assets, and you lost your real estate value. And we've obviously made it through it and did really well. But going back to that period, you think you're prepared for it, and you're really not prepared for it until you've been through it and know how to, prepare for, recessions and pullbacks going forward. You learned a lot from it, but I don't want to go through it again. And that's, probably my biggest money mistake was back then.
Wow. All right, and number 4, what was I'm sorry, this is number 3. Number 3, is there a book that inspired your journey or changed your perspective?
I wouldn't say there's one that inspired my journey. My journey started because I grew up without, we didn't grow up with any money growing, very low to middle income class family, outside Omaha, Nebraska. And that's what inspired my journey, was to, just grow up with more than what we had as kids. Um, but I read a book here recently that I think is really good, that I would recommend for people to read, called The Philosophy of Money.
Hmm.
You heard that? Um,
Philosophy of
Morgan,
money.
now I can't think of who wrote it. I was gonna say Morgan Wallen, but he's a country singer. It's, Morgan Housel.
Okay.
Morgan Housel's book, Philosophy of Money. It's really good.
Okay, yeah, I haven't heard of this one. I might check this one out.
Quick, easy read, puts things in perspective. I think it's a great read.
Okay. Yeah, let me check this one out. Add it to the list. I've seen the psychology of money, but never the philosophy of money.
That's what it is, Psychology of Money, sorry.
Oh, no. Well,
Yep,
yeah, the psychology of money. Yes, I've seen.
yep.
Yes, there's a good book. The only thing about that one, I would say, is mostly from a male perspective. He doesn't have any women's perspectives in that particular book. That's the only thing I have
Yeah,
against
no,
it.
it's about his journey, and his family's journey, but it's his story, not necessarily his wife's.
That's
But I
true.
still think it applies to, females as much as it does males. But you're right; it's not. It's just it's one guy's, journey with money and how he feels about it and what he's taught
Right.
himself about it. But I still think it triggers a lot of things for people to think about. And I've recommended it to several clients, female clients, and they all love it.
That's great. Yeah, I mean, everybody hands down, I say love it, but I wonder if there's going to be like a rebuttal version,
Yeah.
so
Well,
I
I
can
know in
bring
his
it up.
follow-up book that he came out with, which I can't think of the name of it right now, was not nearly as good as The Psychology of Money.
Oh wow,
I'm drawing a blank on the name, but that's a great book, that I send it out to a lot of clients. So
perfect. Yeah, it's a great book. Number 4. What is your favorite dish to make?
I don't I don't make much anymore.
Right.
When I do make, I like, which it's hard to do, but I love. Um, I get a big green egg, and
Mhm.
doing a brisket on that, is probably my favorite. But I've also butchered it several times. So, but but if I do it right and I get it to where it's actually get the bark to it, and you get that, the tenderness to it, where it doesn't overcook it and dry it out, it's phenomenal. But it's a hard meat to cook,
Yeah,
but that's my favorite.
nice. Yeah, I mean, you can tell from your work ethic, like this is something that you definitely going to figure it out eventually. So.
I keep trying. Sometimes I get it, sometimes I don't. But I still get the flavor to taste good, but I can't get that tenderness sometimes.
You might gotta find a book on it.
I've got like six, and I follow it, and I still struggle with it.
It's 6 books. I don't know.
Yeah,
Might have to get a private chef to kind of walk you through. Have you tried that yet?
no, no, not yet.
Okay, that might be the next one. All
Yeah.
right. So the very last question of the show, which is where can people find out more about you?
Yeah, our website is seapointwealth.com. So it's sea like the ocean, SEAPOINT wealth.com. That's my website. It has my team on there, the other advisors in our office, And then my email is chad@seapointwealth.com, and I'm happy to answer any kind of questions anybody has, or explain anything else in more detail for them.
Yep. And remember, if you guys are looking for something, Seapoint Wealth really works with individuals and families whose financial lives have grown increasingly complex over time. And if that's you, life happens, they're there for you. So, man, Chad, this has been such a pleasure having you on the show. I know this is live, this is new for my audience. So, this is going to be actually really entertaining for everybody, even myself. And thank you, Dr. Seth, for coming through. And yeah, man, that's it. I don't have like outro music for my live, so that's one of the things I'm working on too. But we here. All right. Well, thank you, everybody. Y'all be safe.
Thank
We
you,
out.
Anthony. I appreciate it.
Peace. You're welcome.